Welcome back, traders. This is part 3 of our chart pattern series, and today we're focusing on triangle patterns. Starting with the ascending triangle, let's break it down step by step. The ascending triangle is a bullish chart pattern, which indicates that the market is preparing to move higher. In an ascending triangle, you'll notice a series of higher lows that converge toward a flat resistance line, a classic sign of bullish pressure building up. Higher lows show that buyers are willing to step in at increasingly higher prices. If buyers weren't interested, you wouldn't see these higher lows forming near resistance. This continuous demand pushes price closer to a breakout. At the same time, the fact that price stays near resistance instead of quickly dropping tells us there's a lack of strong selling pressure. In other words, even though resistance is an attractive level for sellers, it's not pushing the market down. Another key factor is the cluster of buy stop orders sitting just above resistance. Each time price tests that level, traders who shorted the market place their stops above it. When a breakout finally occurs, all of these stop orders get triggered, fueling a strong upside move. That's why, while trading the ascending triangle, don't fall into the common trap. Textbooks often say, sell at resistance, but not all resistance levels are for shorting. Pay attention to how price is approaching the level. A clean series of higher lows into resistance signals that buyers are in control, and a breakout is likely. Since you've learned that higher lows forming at resistance indicate bullish strength, it means the market is likely to break out above that resistance. In this situation, you don't want to take a short trade and go against the trend. Now, let's talk about entry criteria. So, how can you make your entry better? There are a few ways to do this. When the price breaks above the high level or the resistance of the ascending triangle, place a limit buy order just above the resistance. As soon as the price breaks out, you'll enter long immediately. This gives you the best price, but it's risky because false breakouts can happen. Instead of entering immediately, wait for the breakout candle to close above the resistance. Then take a long entry slightly above the high of that candle. This lowers the chance of a false breakout. But if momentum is strong, you'll enter at a higher price. If you're more experienced, you can wait for the price to pull back and retest the broken resistance line. Even if you miss the initial breakout, this method can give you a better entry price. But remember, the market doesn't always retest. Choose your approach based on whether you're conservative or aggressive, and always confirm the breakout with volume and other indicators to ensure the market truly wants to push higher. Now let's talk about stop loss. Your stop loss should be at a level where your trade setup becomes invalid. If your stop loss is hit, you'll automatically know the setup failed. It's not a good idea to keep your stop loss just below the resistance line. So where should you put it? Think about it. Where is the ideal place to set your stop loss? It should be at a level that tells you the ascending triangle setup is invalid. Because this pattern forms higher swing lows, if price breaks below the most recent swing low and makes a lower low, that's a clear sign your analysis is wrong. That's why your stop loss should be placed just below the most recent swing low, giving the trade enough room to breathe. You can also add a small buffer, such as one ATR, below that low for extra protection. I hope this is now clear. To maximize profits, where you should exit from your winning trades. As always, there are two techniques you can use: the trailing stop method and the price projection method. With the trailing stop method, the idea is simple. We don't know how long a trend will last. So, as long as the market is moving in our favor, we keep locking in our profits by trailing the stop loss as far as possible, riding the trend for maximum gains. Now, how can you trail your stop loss effectively? For this, we can use moving averages to guide our stop loss placement and adjustments. For swing trades, another option is to trail your stop loss using a moving average. For example, you could use the 50-period moving average and hold your position as long as price stays above it. Why 50? There's nothing magical about this number. It's about your trading style. If you want to capture long-term trends, use the 200-period moving average. For shorter-term moves, you can use a 20-period moving average. Now let's discuss price projection. This is a classical charting technique used to estimate where the market might travel after a breakout. Here's how it works with an ascending triangle. Measure the vertical height of the triangle, from the highest point, resistance, to the lowest point. Add that distance to the breakout level. That gives you the projected price target. One issue with price projection is that markets don't always hit your target cleanly. Sometimes they reverse sharply and head back toward your stop loss. To reduce this risk, you can combine a trailing stop loss with your price projection. In other words, if the market moves in your favor but hasn't reached your target yet, trail your stop using a moving average to lock in profits. This way, even if there's a sudden reversal, you protect your gains and don't give them all back to the market. The descending triangle is another highly logical chart pattern. If traded correctly, it can help you catch upcoming explosive breakout moves. This is a bearish continuation pattern, showing that sellers are in control and the downtrend may continue. Visually, a descending triangle forms as a series of lower highs pressing into a clear support level. This setup reflects weakening demand and increasing selling pressure. Normally, when price drops, buyers step in to push it back up. But inside a descending triangle, that demand is missing. Instead, sellers are willing to sell at progressively lower prices, and that's why you see lower highs forming again and again. Another important point: sell orders often cluster below the support level. Why? Because many traders are taught to buy at support and place their stop loss just below it. As more traders do this, the cluster of stop loss orders below support grows larger. Since the market moves from one area of liquidity to another, it often breaks below support, triggering all of those stop-loss orders. This flood of selling pressure can accelerate the breakdown. As a bearish continuation pattern, the classic way to trade a descending triangle is simple. When price breaks below support, enter a short trade. But if you want to find the highest probability breakouts, you need to pay attention to one detail. The breakdown should occur near the apex of the triangle. The apex is the point where the descending trend line and the support line converge. Breakouts occurring close to this point often have stronger follow-through. You want to focus on shorting near the apex of the descending triangle. This is the point where volatility is lowest and prices are most compressed. When volatility contracts, it often sets the stage for an explosive breakout, and in a descending triangle, that usually means a sharp move lower in your favor. The more times price tests the support level, the better. Why? Because repeated tests attract more buyers, which in turn increases the number of stop orders sitting below support. This is exactly what breakout traders want. If price breaks below support, that cluster of stop-loss orders can drive an even stronger move downward. Now let's talk about how to trade this pattern. Whenever the market drops, it tends to fall faster than it rises. So, if you wait for the breakout candle to fully close below support, the move might already be underway, and you'll be forced to chase it. One approach is to place a sell stop order just below support, so you're triggered as soon as price breaks down. If you're a more conservative trader, you can wait for confirmation. Let the breakout candle close below support first, then enter short on a break of that candle's low. This can help filter out false breakouts, but you'll enter at a slightly worse price. And what if you miss the breakdown entirely? The worst thing you can do is chase the market after the move has already started. A better option is to wait for price to retest the breakout zone. Here, the old support is likely to act as new resistance, giving you a more favorable entry and a tighter stop loss. This setup often delivers a much better reward to risk ratio. One important thing to remember about the descending triangle is that pullbacks or retests don't happen often. That's why it's critical to validate the breakout with volume or momentum indicators. Now let's talk about stop-loss placement. The descending triangle becomes invalid once price breaks and closes above the most recent swing high. So, A logical stop loss should sit just above the most recent swing high. If you want to be extra safe, give it a small buffer. For example, one ATR above the swing high to protect against sudden spikes and stop hunting. How do you exit your winning trades for maximum profit? There are two classic ways, just like with any other chart pattern. Method 1. Price projection. Measure the distance between the highest and lowest points of the descending triangle. Project that distance downward from the breakout point. This projected price level becomes your target to exit the trade. You can also use this projection to decide whether it's too late to enter. If price is already near the projected target, the reward to risk might be gone. The second method is to use a trailing stop loss. Unlike the price projection technique, a trailing stop loss does not use a fixed target profit. Instead, once the price moves in your favor, you trail your stop loss so you can ride the trend as far as it goes. First, decide what kind of trend you want to capture: short-term, medium-term, or long-term. Then trail your stop loss with the suitable moving average. Use the 20-period SMA for short-term trends, the 50-period SMA for medium-term, and the 200-period SMA for long-term. Exit the trade only when the price closes above your chosen moving average. In summary, if you want to capture price swings, the price projection technique works best. If you want to ride a bigger trend, the trailing stop loss method is your go-to. And in our next part, we'll dive into rectangle patterns, another powerful continuation pattern that can transform the way you trade. Before you go, hit like, subscribe, and turn on the bell to catch the next continuation patterns episode. Share this video with fellow traders to help us grow and bring you more powerful strategies.